Markets around the world finished higher in the third quarter. The most notable development was how the tech giants, or sometimes known as the Magnificent Seven, companies like Microsoft, Apple, Google, Amazon, Tesla, and Facebook underperformed the broader market during the quarter. This is actually a positive sign as we see the market rally broadening to other industries and smaller-sized companies. The Federal Reserve lowered interest rates by 0.5% in September. As you can see from the chart, the first rate cut after a long period of the Fed raising rates does not mean the market is going to automatically sell off. The dark blue line is the average stock market performance for all periods 12 months after the first rate cut. The light blue line is for all periods where a recession didn't begin within that 12-month period. The gray line is for when a recession began within 12 months of the first rate cut. As you can see, if we don't have a recession in the next 12 months, which happens to be our base case, it should mean the stock market does just fine. How can the stock market be up so much even in a slower growing economy? Earnings and profits of the largest 500 companies in the United States continue to grow. This chart looks at the earnings per share of the S&P 500. Earnings and profits of these companies have never been higher, which makes sense why the market continues to make all-time highs. Another reason the market continues to hold up is that inflation has moderated significantly and is now within reach of the Federal Reserve's 2 to 2.2% objective. As you can see from this chart, the stock market has the best performance when inflation is in the 2 to 3% range. I always like to use the Goldilocks analogy. Not too hot, not too cold, but just right. The economy isn't overheating with high inflation. It's not recessionary where prices are dropping because of a lack of demand. It's just right between 2 and 3%. This is the ideal environment for strong stock market returns. Even though we've had 2 years of above average market returns, it's important to keep realistic expectations about the future. This chart shows the average stock market performance the first 3 years of an economic recovery. The first 2 years are positive 100% of the time, with average returns of 40% and 13% respectively. This is like what we experienced in 2023 and so far in 2024. However, year 3 of an economic recovery isn't nearly as strong. The market is positive about 63% of the time, with average returns of 2%. Now, we aren't anticipating anything catastrophic to happen next year, but there is a low likelihood of above average returns 3 years in a row. In summary, economic growth is projected to stay positive, and the market continues to reach all-time highs. Now is a great time to connect with your advisor to ensure your allocation of stocks and bonds is properly positioned. Thanks for watching. Have a great day.